Okay, in this video, we're continuing our discussion of AUC Section 315 for understanding the entity and assessing the risk of material misstatement. And so in the past couple of videos, we've been going through this AUC Section 315.12, which helps us to understand the entity and its environment. So we first looked at the industry and regulatory environment and the nature of the entity, and the next few entity selection of their accounting policies and their objectives and strategies. So now for this particular video, we'll take a look at E, which is the measurement and review of their financial performance. So as we are going through each of these steps and we're understanding the entity, we want to understand how do they determine whether they are meeting these objectives and strategies. And this might tell us a lot about some of the risks that we have. So let's go down into the explanatory material, sections A43 through 48. Okay, so now we're down in the explanatory material section for measurement and review of the entity's financial performance. So when we're learning about this, we will learn how management views whether or not they are achieving their objectives. And so management would set, for instance, performance targets, or external people, for instance, regulators might set particular targets that the entity has to meet. So then this would help us understand the pressures that management has in meeting those targets, and that would in turn tell us what motivates management to take certain actions. And accordingly, it might help us understand, for instance, the risk of fraud, depending on how important it is for management to hit those targets. So if management is required by the regulators to have a certain amount of working capital, let's say, then there's a supreme pressure for management to hit that working capital. So they might over accrue some of their current assets or under accrue some of their current liabilities to make sure they meet that working capital threshold, so their business doesn't lose the ability to operate. Let me emphasize here that the measurement and review of financial performance is not the same as monitoring of controls, although they do sort of overlap in some ways. For instance, measurement review of performance is directed at whether the performance is meeting objectives set by management, and monitoring of controls is specifically concerned with the effective operation of internal controls. That's the difference between those two. They certainly have the internal controls might have they might be a performance metric that management and the staff of the company are meeting their internal control requirements. And so as we have learned in regard to understanding entity and its internal control, we're required not only to understand the design and of the controls, but also we need to understand whether or not they've been implemented and how so. So some of the things that we might request and inspect or observe related to management's measurement and review of their financial performance might be we would want to see maybe the key performance indicators, either financial or non-financial. So if their performance indicator is potentially a revenue target, that would be the financial piece, but that would be related to the non-financial piece, which might be the prices of the products or services and the volume of products and services. So perhaps the entity is required or is shooting to have to sell a certain amount of widgets or hours or particular services. It might also, the performance indicators might be period-on-period financial performance analysis. So perhaps they've built something like this that we could obtain a copy of to look at. Budgets, forecasts, variance analysis, and so on. Employee performance measures and incentive compensation policies. So, for instance, we might see if employees are required to work a certain amount of hours in order to achieve a bonus, then we might look at that compensation policy, perhaps in the employee handbook, and also to see the calculations by management that shows whether or not they met those targets, and also comparisons of their performance with other competitors. So they might look at the revenues or number of customers served or products sold, etc., and compare that to the competitors to see whether they are in line with their competitors, as well as maybe the pricing of their products and services as well. So if we take a look at those things, we might understand a lot about the organization's performance measures and what they're trying to achieve as they are operating the company. And as we mentioned before, there might be a lot of external parties who have certain performance metrics that they're looking to achieve. For instance, if this is a publicly traded company, perhaps analyst reports or credit rating agency reports. So the entity is looking to perform well enough to meet some of the analysts and credit reporting agencies' thresholds. If it's more of a privately held company that is looking to maybe sell to an investor or something, their performance measures might be EBITDA, for instance, as opposed to a particular GAAP measure. And so not only understanding the risks related to these performance measures from a fraud perspective in the case of perhaps employees or management trying to hit certain targets, we might also use these performance measures as a way for us to understand how the entity is operating in relation to, for instance, others within the industry. So if we're looking at the performance measures of sales or something like that, we compare it to their competitors, we might see that the entity is having rapid growth or profitability, which could potentially cause a lot of problems, and from a managerial standpoint, but also a financial statement standpoint, because potentially maybe their accounting policies are a lot more complex now. Or, for instance, in our analytics, we might expect if there's rapid growth, then they should possibly have rapid not only sales increases, but also expense increases and potentially debt, all the things that come with growth. And then, of course, with growth and incentive compensation in general, there's a risk with performance-based bonuses or incentive remuneration, which creates the risk that management might mold the financial statements or accounts in a way that makes their bonuses higher.